Hello fellow traders. Today is another video of many where we're going to get into a quick take on stocks, part 1. What is a stock? A stock represents ownership in a company and is also known as a share or equity. When you buy a stock, you're purchasing a small piece of ownership in that company. Stocks are traded on stock exchanges such as the New York Stock Exchange, NYSE, or the NASDAQ. Stock prices fluctuate based on supply and demand and influenced by factors like company performance, market conditions, and investor sentiment. Owning stocks can offer potential for capital appreciation, increasing the stock price, and dividends share of company profits. Stocks can also be categorized into different types, such as common stocks, preferred stocks, each with distinct rights and benefits. Investing in stocks carries risk as prices can go up or down, and you can lose money. Investors often buy and sell stocks with the goal of achieving long-term growth and generating income through dividends. Companies may issue additional shares of stocks through processes like initial public offerings, IPOs, to raise capital. Stock ownership entitles shareholders to certain voting rights and the right to participate in corporate decisions. How does a stock fit into the markets? First, the concept of a stock. Stock represents ownership in publicly traded companies. Companies issue stocks to raise capital for growth and expansion. When you buy a stock, you become a shareholder and own a portion of that company. The importance in financial markets. Capital formation. Stocks allows companies to raise funds by selling shares to investors, enabling them to invest in new projects and grow their businesses. Investment opportunities. Stocks provides investors with opportunities to participate in the potential success and growth of various companies across different industries. Liquidity. The company or stock market provides a liquid platform for buying and selling shares, allowing investors to convert their investments into cash relatively quickly. Price discovery. Stock prices are determined by the interaction of supply and demand, reflecting market sentiment and perceived value of a company. Benchmark for performance. Stock market indices like the S&P 500 serves as benchmarks for overall performance in the economy of specific sectors. Economic indicators. Stock market movements can be indicative of overall health of the economy and influence consumer business confidence. Risk management. Investors can diversify their portfolios by holding a mix of stocks, which can help reduce the risk compared to investing in individual companies. Retirement planning. Stocks can also be a part of long-term investment in a long-term investment strategy, helping individuals to build their wealth and plan for retirement. Corporate governance. Stockholders have rights and can influence important corporate decisions, promoting better corporate governance practices. Overall, stocks play a crucial role in functioning in financial markets, providing opportunities for companies to raise capital and for investors to participate in wealth creation and economic growth. However, it's important to note that investing in stocks carries risk, and investors should conduct proper research and exercise due diligence when making investment decisions. Let's talk about some of the benefits of investing in stocks. The potential for capital appreciation. Investors that hope the value of the stocks will increase over time allows them to sell it at a higher price, making them a profit. Longer-term growth stocks or long-term growth. Stocks can offer potential for long-term growth, allowing investors to accumulate wealth over the years. Dividend income. Some companies pay dividends to their shareholders, providing investors with a regular stream of income. Diversification. Investing in a variety of stocks can help spread the risk across different companies and industries, reducing the impact of any single stock's performance on the overall portfolio. Inflation hedge. Stocks historically have outpaced the inflation, helping investors to preserve their purchasing power over the long term. Ownership in companies. Owning stocks grants shareholders partial ownership in the companies, giving them a stake in their success. Access to different sectors. Investing in stocks allows for individuals to participate in various industries and sectors of the economy. Flexibility. The stock market offers liquidity, allowing investors to buy and sell stocks relatively quickly compared to some other investments. Investment options. Stocks offer a wide range of choices from stable, well-established companies to smaller, high-growth potential companies. Retirement planning. Investing in stocks can help individuals build a retirement nest egg and provide their financial future. Participation in economic growth. By investing in companies, individuals can contribute to economic growth and job creation. The potential for a beat of the market, skilled investors or fund managers may aim to outperform the market, leading for higher returns. Now let's cover some market basics. Definition. Stock market is a platform where buyers and sellers trade stocks, shares of publicly listed companies. Stock exchanges. Stock markets operate through exchanges like the New York Stock Exchange, NYSE, or NASDAQ, providing a regulated environment for trading. Company listings. Companies go public through initial public offerings, IPOs, issuing shares to the public, and getting listed on stock exchanges. Ticker symbols. Stocks are identified by ticker symbols, usually short codes representing a company's name. Example, AAPL for Apple Inc. Stock price. Stock price is determined by the company's supply and demand, reflecting investors' perception of the company value. Market indices. Indices like the S&P 500, Dow Jones Industrial Average, represent a selection of stocks and serve indicators as the market's overall performance. Stock market hours. Stock exchanges have specific trading hours, typically from morning to early afternoon on business days. Buy and sell orders. Investors place buy, bid, and ask, sell orders through brokers or online platforms to execute trades. Market orders. A market order buys, sells a stock at prevailing market prices, while a limit order sets a specific price for execution. Brokerage accounts. Investors need a brokerage account or brokerage accounts to buy and sell stocks. Online brokerages offers easy access for individual investors. Fees and commissions. Brokers charge fees and commissions for executing trades, which can impact overall investment costs. Stock splits and dividends. Stocks may split their stocks or adjust their prices, pay dividends to distribute a portion of profits to shareholders. Volatility. Stock prices can fluctuate based on company performance, economic factor news, and market sentiment. Risk rewards. Investing in stocks carries risk, but also potential rewards through capital appreciation and dividend income. Long-term investing. Some investors adopt a buy and hold strategy, focusing on long-term growth and weathering short-term market fluctuations. Research and due diligence. Understanding a company's fundamentals, financials, and industry trends is essential to informed investing. Diversification. Spreading investments across different stocks and assets classes to help manage risk in a portfolio. Investor education. Being well informed about investing concepts and staying updated on market trends and enhancing decision making. Remember, investing involves risk, it's essential to be aware of your financial goals, risk tolerance, and time horizon when entering a stock market. Seeking advice from financial professionals can also be beneficial. Now we're going to get into market capitalization and stock price. Stock prices determination. These are things that will influence a stock price at any given time. Supply and demand. Stock prices are influenced by the balance between buyers and the demand and sellers' supply in the market. Bid and ask. Buyers place bids, sellers place ask, and the market prices determine where they meet. Market makers. Market makers facilitate trading, ensuring liquidity and efficient execution of trades. Company performance. A company's financial health, earnings, and growth prospects impact a company's stock price. Economic factors and market sentiment. Economic indicators, interest rates, and general market sentiment are also influence on stock prices. Market capitalization and company value. Market capitalization and calculation. Market cap is determined by multiplying the stock price by the total outstanding shares. Size comparison. Market cap allows comparison of company sizes and identifies larger or smaller firms. Relative volume. Market cap helps evaluate a company's relative to its peers in its industry. Investor perception. Market cap affects how investors perceive a company's stability and growth potential. Index inclusion. Market cap determines eligibility for inclusion in the stock market indices, impacting the visibility and investment. Market cap categories. Companies are categorized as large cap, mid cap, small cap based on their market cap. Changing value. Company capitalization fluctuates with the stock prices and changes due to corporate actions like stock splits. In essence, stock prices depend on market forces and company performance, while market capitalization reflects a company's overall value and plays a vital role in determining the position in the market. Thank you for giving this video a watch. I hope that it was useful information that you can use into the markets and really start reaping profits. If you like this and you find this information useful, please like, share, and subscribe for more videos that are coming in the future.